So here's an example of one that we did. I was trying to lay out something here so you can see how this can be a benefit if you're, to take advantage of time decay while you wait. So in this example here, let me kind of walk you through it. This is on GLD, the gold ETF. So this trade setup, we did this back on the 4th of January, just to kind of walk you through the trade. And at that point in time, it was trading at 169.37. So I've got alert service, and this was an alert trade sent out. So you can see here it said GLD long. This should have been 169.37. So it said buy to open calendar the 28 Jan. So you'd be long the 28 Jan 171 call, and then short against it the 7 Jan 171. All right, so you're long the 28 Jan 171 call, short the 7 Jan 171, so closer in, short that for theta decay. In this trade, the cost of the trade was $1.25, your debit cost. So that's the maximum you could lose in your debit cost. Now we did a couple adjustments on it, so let's walk through. So on the 6th, it was now trading below. It's now trading down to 167.05. So what we did in this, when it traded down here, we were able to close out the 7 Jan 171 call that we shorted, okay, for a nice profit, and then did a roll where we rolled to the next series. We went to the next option series out, which was the 14 Jan, and sold again the 171 call and brought in $21 credit. All right, so we worked the trade. We're amortizing now the trade. So we ended up with the adjusted trade. We're still long that the 28 Jan 171 call, but we've reduced the cost of that by the credit, the profit we brought in from covering back that 7 Jan call here. So we amortized down this long call cost here, and then we sold the 14 Jan call against it, and now we had an adjusted price of the trade down to 90 cents. So we went from $1.25 now down to 90, and we're still in the trade. So as long as your trade holds your support area or resistance area that you're looking for, you're good to go. So then did another adjustment here on the 13th. So again, it was at this point trade at 170, so it's still trading right below the 171 short strike. So closed out the 14 Jan 171 call for another profit. Okay, so it took some more profit there, like the cover call. So profit, and then against it sold. Now it started to inch up a little bit, so we decided, okay, let's sell the next series out. So we went from the 14 Jan to the 21 Jan, and instead of selling the 171 call, we're starting to see a little bit of movement to the upside. So we decided to go ahead and spread this trade out. So then we sold the 172 call against it, right at $40 credit. So we just adjusted this to what we now call a long calendar diagonal. So now we've got the adjusted trade. We're long the 28 Jan 171 call, long the 28 Jan 171, now short the 21 Jan 172. So we've got a dollar-wide spread, and now we've got our trade cost down to 78 cents per spread. So we've amortized down the trade costs, and now we've made this into kind of a more diagonal spread to give us more potential profit if we get that direction to finally kick in. So the outcome is on the 20th, now it was trading at 172.46. So it took 16 days to get there, but now the trade has moved up. We amortized the trade cost down over two different, adjustments. And now we're long that 28 Jan 171 call, short the 21 Jan 172, that adjusted price of 78. And the market was trading up here at 172, so we had profit in the trade. But here was the adjustments I'll show you real quick here, so you can kind of visualize that. So set the trade up right here. It's trading right there at 169.37. Now then, see it drop down here. So when it dropped down here, we did this first adjustment. Okay, it was trading 167. Then it stabilized, started moving back up, came back off. We were able to do another adjustment here, and ended up with the trade adjusted cost of 78 cents, and then it finally made its push here and closed out the trade. So this lets you hang with the trade if you want, and this is one way to do it, and it's a great strategy for, I like it a lot when you've got a market that's maybe come down real hard like we're experiencing now, and then starts maybe to show you a little bit of a bottom, but it could take a while for it to finally turn up. So great type of setup for that pattern. Or if you're in a market where it's been just grinding up and finally starts to stall out and exhaust is a good one for that as well. So that's the calendar. The offshoot is a calendar diagonal. So here was the trade. We adjusted it down to now a cost of $78, okay, from those two adjustments. And so we had the spread cost at 78, sold the spread at $1.44. So that gave us 66%, $66 per spread profit, or 85% return on your risk of 78. So here it was. It still had potential for a lot more profit in here, but took it off right in there. So it went from 78 to 144. So that's your profit of 66 there. So kind of similar to the credit spread, but gives you that dynamic of being able to stay with the trade longer.